So very good afternoon to all webinar participants and our guest speakers. I hope I'm audible.
Right. Yes, yes.
Yes, yes.
So my name is Bexy Kuriakos and I head the Center for Content Creation at NISM, the National Institute of Securities Markets. NISM is a public trust established in 2006 by the Securities and Exchange Board of India, that is SEBI, the regulator of the securities market in India, as all of you would know. The institute carries out a wide range of capacity building activities at various levels aimed at enhancing the quality standards in securities markets. As part of its capacity building initiatives, NISM also offers a bouquet of 60 plus online self-paced e-learning programs, including skill development modules. These range from basic financial literacy courses in English and vernacular languages to specialized niche courses on topics spanning investment management, fixed income, equity derivatives, ESG, wealth management, forensic investigation, anti-money laundering, securities law, broking operations, and many more such areas related to Indian securities market. The courses can be accessed through NISM's LMS, that is a learning management system, at online.nism.ac.in. I'll be sharing the link to the LMS in the chat box shortly. Coming to today's webinar will focus on our e-learning courses in the fixed income space, which we offer in collaboration with FIMMDA. FIMMDA is a voluntary market body for the bond, money, and derivatives markets. FIMMDA has members representing all major institutional segments of the market like banks, insurance companies, and primary dealers. We have 4 online self-paced e-learning courses that NISM runs in partnership with FIMMDA. These are Introduction to Fixed Income Securities, Introduction to Fixed Income Mathematics, Introduction to Interest Rate Derivatives, Overview of Indian Debt Markets. So now I would like to take this opportunity to introduce our guest speakers today who will take the session. First, we have Mr. A. Murli, Vice President Finance and Admin from FIMMDA. Mr. A. Murli is a highly experienced banking professional with over 37 years of distinguished service in Central Bank of India. Over the years, he has held diverse and responsible positions, including branch head, faculty leader at the Bank Zonal Staff Training Center, and registrar in charge at the Debts Recovery Tribunal, Mumbai, on deputation. At the bank's head office, he contributed significantly in the balance sheet department, overseeing the preparation and finalization of bank's annual accounts, and in the recovery department, handling stressed assets and recovery management. With his rich and varied experience across operations, finance, recovery, and training, Mr. A. Murli brings deep insights and practical knowledge to the banking and financial sector. He will be assisted by his colleague Shiraz in the presentation. Over to you, Mr. Murli and Shiraz.
Thank you.
Thank
Ms.
you.
Bixi. Thank you, Ms. Bixi, for the kind and thoughtful introduction. Should I start?
Yes, please do.
Okay. So, good afternoon, everyone. I am delighted to join you today on behalf of Fixed Income Money Market and Derivative Association, FIMMDA, to briefly introduce our partner courses with the National Institute of Securities Markets. In today's session, I will start with a brief introduction about FIMMDA, then speak about our collaboration with NISM, and conclude with why this program is important and how it can benefit you. To make today's session easier to follow, I will be using a short PowerPoint presentation. This will help you visually connect with the key points I will be discussing, whether it is about FIMMDA, our partnership with NISM, or the importance of this program. So, first of all, let me start with a brief introduction about FIMMDA, Fixed Income Money Markets and Derivatives Association of India. So as you know, FIMMDA is a voluntary market body for the bond, money, and derivatives markets. dedicated to promoting transparency, standardization, and orderly market development. We are an industry association representing commercial banks, public financial institutions, primary dealers, and insurance companies. We have presently we have around 116 members on our roll. FIMMDA plays a very key role in developing market standards, codes, and best practices in the fixed income, money market, and derivative segments. One of FIMMDA's core objectives is to enhance the knowledge, skills, and professionalism of market participants through continuous training and education. FIMMDA conducts specialized programs and workshops on topics such as bond mathematics, fixed income derivatives, and bond portfolio management. We also work very closely with the regulators, market participants, and other institutions to promote efficiency and integrity in the financial markets. I am very happy to share that FIMMDA has recently been certified by the Reserve Bank of India as a self-regulatory organization, that is SRO, in the financial market regulated by Reserve Bank of India. Now let me come and briefly describe our collaboration with the NISM. What is the objective? One of our key objectives of our collaboration with NISM is to promote capacity building and facilitate knowledge sharing among market participants. The uniqueness of this collaboration lies in the combination of FIMMDA's market and regulatory experience and NISM's academic expertise. This partnership is about helping participants understand concepts and apply them confidently in real-world situations and grow as experts. So to address this, we have jointly developed 4 e-learning courses. The details will be shared by Mr. Sunil, but I will just give a brief introduction. One is Introduction to Fixed Income Securities, which provides the foundation of bond markets, instruments, and key features. Number 2 is Introduction to Fixed Income Mathematics, which explains the quantitative tools such as yield, duration, convexity, and pricing techniques. The third one is on Introduction to Interest Rate Derivatives, which focuses on forward rate agreements, interest rate swaps, and how these products help manage risk. And the fourth one is Overview of Indian Debt Markets, which gives participants a clear picture of market structure, trading mechanism, and regulatory framework in India. So now coming to the next point is why you should consider enrolling in this program. The most important for all you participants, why you are required to enroll in this program. Our programs offer a very well-rounded approach. It not only explains the key concepts, but also connects them with the real market practice. Whether you are already working in the field or just starting your journey, you will find the content practical and relevant. These courses help the participants gain confidence to apply their knowledge in real situations. It really helps in developing a deeper understanding of how the markets function. And most importantly, the fourth point, the response from our past participants has been very encouraging. Many have shared their program, helped them grow both personally and professionally. So before I conclude, I warmly invite you all to explore these FIMMDA NISM courses and take advantage of this opportunity to learn from experts and stay ahead in your professional journey. So learn, grow, stay market ready. We look forward to your active participation. Thank you.
Thank you very much, Mr. Murli, for that introduction to FIMMDA.
Okay,
And, your speech has helped to, sort of validate our continued collaboration between NISM and FIMMDA. Thank you, Shiraz, as well.
thank you.
I will now move on and would like to introduce our second speaker for the day, that is Mr. Sunil Gaude. Mr. Sunil Gaude is adjunct faculty at NISM, and he has also been associated with our fixed income courses as an instructor and trainer. I would like to just introduce him. Mr. Gaude is a cost accountant and holds a BCom degree. He is a seasoned financial market professional with 19 years of experience at the National Stock Exchange. At NSE, he was responsible for business development in currency and interest rate derivatives and the debt market, with prior experience in trading operations within capital and debt markets. Currently, he is consultant for risk and operations at AMC Repo Clearing Limited and has been associated with NISM as a resource person for the past 4 years. In this capacity, he has contributed to updating certification examination workbooks for securities operations and risk management, currency derivatives, and interest rate derivatives. He has also delivered presentation on various financial market topics. So he will be speaking more in detail about fixed income as well as these courses. And Sunil, you're there?
Yeah, I'm there.
Yes, you may share your screen.
Okay.
And also, I want to let participants know that we will have a Q&A at the end of Sunil's session. So appropriate questions regarding the e-learning courses will be taken up. So you may keep posting your questions in the Q&A box. Thank you. Over to you, Sunil.
Okay. Thanks, Bexy, for this kind words. Now, good afternoon all. Today we are going to discuss about fixed income securities and fixed income market. Basically a very important topic, but very neglected topic in India, I will say. So for development of any financial market or economic growth, it is very, very important that how you should have a very well developed equity market. Similarly, it is very important to have a very developed fixed income market. So people, when think about financial market, they only think about equity. But at the same time, the fixed income market or fixed income securities are very, very important. So in my presentation, I may use the word bond market, fixed income market, or a debt market. Everything has the same meaning. Okay, so basically when we are talking about fixed income market, so what is this fixed income securities? So basically it is nothing but the borrower is borrowing money and from the lender. But in general case, when you borrow money from the lender, it is considered as a loan. But here we are talking about securities. So when somebody borrow money from anybody, he's issue some security, which can be a bond or a debenture. In case of government, it is a government securities, can be a commercial paper. So you have a securities. Why the securities is important? Because once you have a securities, it is tradable in the market. So in case of fixed income securities, as the word says fixed, so you have some fixed income, which is in the form of interest. So the borrower will pay a periodic interest to the lender or the person who has buy that security from the issuer. And at the same time, after certain period of time, so it has a fixed date also. So after certain period of time, he has to return back the money. So principal amount will be returned. So this is a differentiation between the equity and fixed income security. In fixed income securities, the return is not fixed, but the income is fixed, which is a coupon, which is paid periodically. And at the same time, you have a fixed maturity date, which can be 5 year or a 10 year, after which the principal amount has to be paid back by the borrower or the issuer to the lender. Only difference is this, since it is a security market, there is a underlying securities which can be traded in the market. Otherwise, banks also provide a loan to the market players, but that is a credit market where there is no underlying securities. So that is the basic difference when you consider loan against a borrowing against a fixed income securities. So this is the way generally you have a fixed income securities where the issuer will issue money at specific period of time and he will receive the money. and subsequently he will pay a coupon, which is the interest, which will pay periodically. The period can be half yearly or a quarterly, and at the end there will be a redemption. So this coupon can be whether it is a fixed coupon or a floating coupon, or the coupon can be paid at the end of the maturity. So there is a differentiator between this equity. In equity, you don't have a fixed coupon because the dividend can be changed based on the profitability. There is no fixed maturity because it is a perpetual. So only in case of winding down, the equity owner will get the money. And in equity, you become the owner. In case of bond, when the investor buy a bond, he will become the creditor and not the owner of the company. So that is again a very important difference. He does not have any voting rights and other things. So that is a difference between the bond and equity. And in most of my presentation, I will try to compare bond with equity so that it will be easier for you people to understand these things. Now, we always say that the fixed income securities is little complex. Why it is little complex? Now, when you talk about the equity, we just know, okay, State Bank of India, what is today's price? 950 rupees. What is the face value? Say 2 rupees or a 5 rupees. That's it. We require those information only. Or at the most, if somebody is coming with the IPO, we would like to have a issue price. But in fixed income securities, there are various components. There will be a issue price, which can be equal to face value. If it is equal to face value, it is considered as the issuance at par. It can be at discount, it can be at premium. The face value at which the interest will pay. Say, for example, the face value is 1000 rupees and the interest is 7%. So you are getting 70 rupees. Now, this 70 rupees you are getting annually, or whether you are getting half yearly, or whether you are getting quarterly. That will come under coupon frequency. Now, what is the date? Whether you are getting the coupon on 1st April and 1st October, or whether you are getting on 1st May and 1st November, if it is a half yearly. So there will be a coupon date. Maturity date, as I said, okay, the fixed income securities will get redeemed at a specific date. So there will be a redemption date. So that is called a maturity date. So suppose on 1st April 2025, somebody issued a bond for 5 years. So on 1st April 2030 will be a maturity date on which the borrower has to return the principal. What will be the redemption value? Generally, it is equal to face value. So if it is 1000 rupees, the redemption value can be 1000. But again, the redemption can be at discount or redemption can be at a premium. And call and put option. So basically, you know all about the options that call give the issuer the option to redeem before the redemption date. So suppose 5-year bond is there and the call date is after 3 years. So after 3 years, he can basically redeem it. And put option give basically a right to the investor to go and take his money before the redemption date. So put call date. So these are the few components, but there are many components are there of fixed income securities. And because of these various components, you have a various kind of fixed income securities. So if I ask somebody ki, what are the different kinds of equity shares, there is no different kind of equity share. At the most, people will say ki, okay, there is a differential voting rights equity shares are there, which I think Tata Motor has bought a few years back. And there is, you can say, Indian depository receipts. You will not find any other different type of equity shares because equity share is a equity shares. SBI is issuing a equity share today. After 1 year, he will issue the same equity share with the same ISN. After 20 years also, he will issue the same equity share with the same ISN. It is not going to change. But that is not the case in case of fixed income securities. The fixed income securities are distinguished based on the basically various components which we have saw. So for example, if you are a 2-year maturity period bond, we will say it is a short-term maturity. If it is a 5-year, we will say it is a mid-term, and so on. Similarly, if we are saying there is a staggered maturity, means he is paying 25% every 3 years. So it is a staggered maturity bond. So based on maturity. Now, based on issuer, why it is very important to bifurcate fixed income securities based on issuer? Because issuer can be central government of India, it can be state governments, it can be public sector units, it can be private sector. So the reason for distinguishing is mainly because state government bond or a central government of India's bonds are regulated by Reserve Bank of India. So their issuance process, regulations, trading is totally different as against the corporate bonds of public and private sectors or say municipal bonds, they are regulated by SEBI, mainly regulated by SEBI, and hence the regulations related to issuance, trading are little bit different. So that's why the distinguish there based on the issuers. Then based on the security means I will say that some bonds are basically mortgage against some assets, say against machinery. So they have more security. Embedded options, we already see call options, put options, priority of claims. Some bonds are senior bonds, so they get the first priority in case of any winding down or a bankruptcy. And there are subordinate bonds. So senior bond is less risky, subordinate bonds are more riskier. Then based on the credit quality, there will be AAA bond, AA plus bond, or we call junk bonds or investment grade bonds. So again, based on the credit quality, based on coupon, fixed coupon bonds, floating coupon bond, zero coupon bond means there is no coupon in between. You get the coupon at the end of the maturity. In case of floating rate bond, the coupon is not fixed. It depends upon certain benchmark. So you can see that there are various kinds of different securities are available, and it is very very important when you are trading or when you are investing or when you are in the fixed income market to understand the pros, cons, and various features of all these bonds, because it is not like that okay, somebody know okay, I want to buy SBI shares, that's it, then you have to only see that. But if I say okay, I want to buy a REC bond, then REC bond of 5 year, then in 5 year also there will be might be a three securities with the three different coupon. One coupon is half yearly paid, another is yearly paid, third one is a zero coupon bond. Then one might be have a seniority in claim, another may not have seniority in claims. So that's why it is very important to understand the various feature related and types of these fixed income securities. Now there is general consensus that okay, fixed income security is there, it means fixed income is there, so there is no risk. Okay, but that is not the case. The risk is less, and that's why the return is less, but the risk is involved. So what are the main risks in the fixed income market? So obviously a market risk, because it is a security. So it is traded in the market. So once you trade in the market, the price will move. So what is the factor which basically important factor which move the prices of a security? The interest rate which is there in the market. So there is an inverse relationship between the interest rate and the price of the fixed income security. So when interest rate goes up, the price will go down, and when interest rate goes down, the price will go up. So obviously when interest rate going up, your interest rate risk will increase, your market risk will increase. If interest rate is going down, obviously the market risk will be going down. The opposite case in case of reinvestment risk. So what is reinvestment? Now, as I said in our example, I have a 1,000 rupees bond and I am getting 7% coupon. So 70 rupees I am getting every year. So that 70 rupees I have to invest every year. So when I go and invest the 70 rupees, I have to get some coupon or rate on that. So obviously if interest rate is going down, I will get a less return on that reinvestment. But if the interest rate is going up, I will get a higher return. So you can see that for a same bond, I have one risk against the interest rate increasing, and the another is where I even interest rate is going down, I have a risk. Then credit risk is there. So there is a possibility of the bond is get defaulted, especially in case of corporate bonds. Liquidity risk, you are not able to sell the security in the market. Call risk, if it is a callable bond and the basically issuer has asked for the bond before the maturity and you want to hold that bond till maturity. Inflation risk is basically your inflation is more than your earning, so you are getting a negative real rate. So these are the various risks are associated with the fixed income security. So you need to understand all those risks in detail while basically participating in the fixed income market. Now, can there be a risk-free interest rate? Yes, there can be a risk-free interest rate. How? Suppose I invested in the central government securities, then there is no credit risk. If I invested in a zero coupon bond of central government securities, so I will not get any coupon in between, so there is no reinvestment risk. And if I decided to hold these things till maturity, so then there is no market risk, no liquidity risk. So basically, I can avoid if I invest in a zero coupon government bond and hold till maturity, I may not have a risk associated with that security, and then that rate is generally considered as the risk-free interest rate in Indian market. Okay, so now I have talked about the fixed income securities, its feature, then what are the different kinds of fixed income securities, what are the risks associated with the fixed income securities, and all these things you will learn in the e-learning model of fixed introduction to the fixed income securities. So all these things are available in detail. I am just explaining you here in 10 or 15 minutes, so but you are able to learn these things in detail in the e-learning model of fixed income securities. Now, let's go to the most important part of the fixed income securities, which is a bond mathematics. It is very, very important to learn the bond mathematics. So if you want to basically do excel in the fixed income securities, then you should know the bond mathematics. So why it is important? Because in equity, let's take the example of SBI, the price is 950. There is a one price which we know. But that is not the case in bond mathematics or in case of fixed income. In fixed income, you will have a clean price where the securities are get traded, but a settlement will happen at a dirty price. What is dirty price? So clean price plus accrued interest. So what is accrued interest? So accrued interest is the interest accrued from last interest payment date till date. Because it is a coupon, fixed income coupon, the coupon there will be every day some price or a coupon will get added in the price, and the price goes on increasing till the next coupon date. So that is called a dirty price. So that's why the trading is happen at a clean price. The settlement will happen at a dirty price. Okay, and there will be a cash flow. Okay, as I said, okay, suppose 1,000 rupees bond, 70%. So 70 rupees I am getting every year, plus at the redemption I will get 1,070 rupees. So I can prepare a cash flow. Now preparation of cash flow is very, very important to determine the yield or to calculate the price. So for all these function, it is very, very important to determine the cash flow. So cash flow will have date and how much money you are getting on that specific date. So bond pricing is very, very important. Now, again, this return is basically provided in form of yield. But why the yield is important now? Just take an example again of equity. Let's say today's State Bank of India price is 950 rupees and HDFC Bank price is 1,900 rupees. So you will still feel that HDFC Bank is costlier than the SBI. No, because SBI is 950 and HDFC Bank is 1,900. You can't compare those two things. Okay, there is a different way of you will check the PE ratio or any other things to compare whether those shares are costlier or cheaper. So similarly in bond, if some bond price is 100 rupees and another bond price is say 101 rupees, it means not that the price of the bond which has 101 rupees is a costlier than the bond with 100 rupees. You have to compare the some other part, and that comparison is generally happen in form of yield. So the basically a bond with the high yield has cheaper with the lower yield. But there are other factors also, whether both should have the same maturity and other things. So then the yield become very, very important, because yield will provide you the return of that bond and not the coupons, because it is possible that you have bought the 1,000 rupees ka bond at 1,020 rupees. So the return will be less than your coupon. And if you bought at say 980 rupees, then the coupon, the yield might be higher than the coupon, because there is an inverse relationship. Okay, so those things you will come to know in the bond returns. And generally, how the volatility of bond is determined based on the coupon rate. If the coupon rate, I have given the picture here, that if coupon rate is high, the generally bond is volatile, all other things remain constant. If the tenor is high, the bond is more volatile. If the yield is high, then the bond is less volatile. So bond with a low coupon, low maturity, low ITM and high maturity has the highest volatility, and bond with the high coupon, high YTM and low maturity will have the lowest volatility, if you see. So this is basically about yield and the yield relationship. Then there will be a yield curve, whether you have a normal yield curve. Generally what happens, okay, if I want to invest in for a 1 year, the return will be 6%. And if I want to invest for a 10 year, the return might be 7%. So as tenor increases, yield or a return increase. So that is called a normal yield curve or a positive yield curve. If it is a reverse way, then it is called inverse yield curve. Then it can be a flat. So there are different term structures as the yield curves are there. So you will come to know that in the bonds written or the bond mathematics. And then bond price sensitivity. We have seen that the bond prices are mainly depend on the interest rate. So if interest rate moves or yield moves, what will happen to the price? Suppose yield move by 1%, what will happen to the price? How much the price will decrease? So that basically, for that we use the duration, modified duration and convexity. So they give us the sensitivity of the bond for the change in the yield. So if anything has a high duration, then the bond is high sensitive. It means the bond is risky. Okay. So these are the convexity is basically provide that the yield price relation. If you see, the yield curve is always convex, so that convexity provide you the details about that. So this bond mathematics is very, very important, whether you want to, as a issuer, you want to borrow money from the market, or as an investor you want to invest money in the market or a fixed income securities. Both should know the bond mathematics very in details. Now this bond mathematics is provided in the second program of fixed income mathematics, and it is provided very in details. Means I have here just included few things, but in the e-learning model you will get this information in details along with the examples, and it will provide you a lot of clarity about the bond mathematics and bond trade, basically bond yielding. So if you want to do a bond trading, before doing bond trading, it is very important to understand the bond mathematics. So this is basically about the bond mathematics. Now the third thing is a bond market, so, or a fixed income market. So as I said earlier, the financial market can be a debt market or a equity market, but financial market mainly bifurcated between money market and capital market. Money market is anything having a maturity less than 365 days is termed, original maturity of 365 days is termed as a money market, and anything above that, it is a capital market. And then capital market is purely for a capital raising, so capital creation happens. Money market is just for the working capital management and your cash management, it is used. And then capital market further segregated between the fixed income market or a debt market and a equity market. And then fixed income market further segregated in the government securities market and a corporate bond market. So whatever I have shown in blue or highlighted in blue is a fixed income market. So money market is also a part of a fixed income market because it has a fixed maturity, which is less than 365 days, and it has a fixed return. Okay, so because of that, it is a considered as a fixed income securities. So you have a money market, government securities market, and corporate debt market. These are the three major market which is available in case of fixed income market. Now, money market is little different from the debt market. Okay, see, money market less than 365 days. So there are two segments in that: purely borrowing and lending segment. Means I just borrow. So there is an interbank market is there, which is called call money market, notice market, term market, where one bank will borrow from another bank, say for 1 day, which is called overnight call money, or can be for 2 days to 14 days, or from 15 days to 31 days. So they are doing it and it is unsecuritized. So there is no collateral, underlying collateral will be there. On the same times, you can borrow money from the market by providing a collateral as a fixed income security like corporate bond, government securities, commercial paper, certificate of deposit. Then it is called repo. So there can be a normal repo, there can be a tri-party repo. So different kind of repo. But again, you can see here, it is purely borrowing and lending of money. There is no securities there, which is changing hand between these two parties. So that is the very important thing in case of borrowing and lending segment. In money market, you also have a asset market where it is like any debt market or equity. There is a primary market where the issuance will happen of that security like commercial paper, certificate of deposit, treasury bills. And then in the secondary market, those securities will get traded in this market. So that's why the money market is little bit difference as compared to the debt market. Now, if you see the debt market, which is basically of a central government and state government securities and non-government securities, we can call it as a non-government securities, or we can call it as a public and private sector or a corporate bond segment. So as we discussed in our first slide, that it is very important to segregate between a sovereign securities and non-sovereign, because regulations, issuance, trading, other guidelines are totally different for these two market. Even though the features, product features are same, but there are different regulations for G6 market, different regulation for corporate bonds and debentures. That's why these are the two major segments. Now here there are multiple primary segment. In equity, we have a IPO. When somebody wants to list, they have to do the IPO, which is a public issue. And post that, they can do a private placement through either QIP or preferential issuance. In case of debt market for government securities, the government securities auction is done by the Reserve Bank of India, and they have articulated the rules, guidelines for this auction, okay, how the competitive bidding will happen, how the non-competitive bidding will happen for retails, what is the way the auctions will be done, and whether it is a price based or a yield based, whether it is a multiple price or a single price, all this information will be provided by the RBI. Now, in case of debt, you don't have to always do a public issuance. Rather, everybody do a private placement. So private placement means what? You go to a limited people and basically do a issuance to that privately people and get your money and give your security. So that is called private placement. So you are going to a limited players. But even though I am calling it as a private placement, I think India is the only country where for a corporate bond, we have a electronic bidding platform for this private placement. And it is very fascinating platform which is available. The stock exchange provide this platform, and 99% of the issuance in corporate bond is happen through a private placement. Less than 1% happen through a public issue, because obviously public issue is a costlier and timely mechanism. Private placement is a cheap, happen fast. See why it is important to have a private placement, because again in equity, SBI has raised money today. So he again raised money through equity, say after 5 years. But REC, SIDBI, NABARD, they are issuing a bond every 15 days. So they are coming in the market issuing a bond. Again, after 15 days, they are coming in the market and issuing another bond. Okay. So for that, it is impossible for them to go a public issuance, and private placement is the preferable choice. Then equity, the trading is happen on the anonymous trading platform of the stock exchange. Okay, only one platform is available there, the trading is happen. That is not the case in case of debt. So in case of debt, there is an anonymous order matching platform available. For government securities, it is provided by Reserve Bank of India through CCL. There is also a stock exchange provide the anonymous platform for debt market. There is a negotiated market available for, so people negotiated on the phone and they report on the stock exchange. Most of the volume in corporate bond happen through a OTC market or a negotiated market. Now there is third part is request for quote platform. So the negotiation which used to happen on the telephone. So SEBI has introduced this RFQ platform where they have asked people to do this negotiation on the screen, so that the proper audit trail is available, there is a transparency, and many people can participate in that. So there is a RFQ platform. And the fourth one, for a retail investors, corporate bond and a G6 market is an institutional market. So for a retail investor, there is a online bot platform providers are there. So there are many stock brokers, debt stock brokers. They provide this bond platform where the retail investor can go and buy the or sell the bonds. Okay, so this is basically about the debt market. So you can see that there are various things are there in the fixed income market. Now your e-learning module related to overview of Indian debt market has in detail capture a money market, how the trading is happens, how the settlement takes place, then your government securities market, how the primary auctions happen, how the secondary market trading takes place, how the settlement happen, who are the participants in those primary and the secondary market, what are the regulations and guidelines of those markets. And third, then corporate bond market, which is mainly regulated by SEBI. What are the regulations for that? How the primary issuances happen in case of electronic bidding platform, in case of public issuance, and then subsequently how the trading takes place in a anonymous platform, in a over-the-counter platform, in the RFQ platform. So everything is detailed provided in the e-learning model related to overview of Indian debt market. Now, the fourth part is basically about the interest rate risk. Now, we see that there is an interest rate risk. Now, if you see in case of equity, again, taking a comparison with equity, when the prices are going up, everybody is happy. Okay, because issuer is happy, his valuation is increasing, the investor is happy because his portfolio value, portfolio's amount is increasing. But interest rate is like a commodity. So when interest rate goes up, not everybody is happy. The person who wants to invest, he will be happy, but the person who wants to borrow money, he will not be happy. And the case, if the interest rate is going down, borrower will be happy. The person lender who wants to lend money, they may not be happy because he will get the less return. So there is a risk when there is a movement on both the sides. So you can see that if it is somebody is holding assets and somebody has having a liability in form of interest rate, their risks are different. Now for banks and other people, there is a different problem. There is a asset liability mismanagement. So for example, banks take FD generally of a 1 year, 2 year, up to 5 years. So their liabilities of 5 years, and they give bonds, issue bonds for 10 years, they give housing loan for 15 years. So their assets are of 15 years. So how they will manage those risks? Because with the movement of interest rate moving up or down, they will have a risk because of either they hold asset and liability, and there is a mismanagement between these assets and liabilities. In addition to that, people like us also indirectly have a interest rate risk because we hold FD, or we have taken a floating rate housing loan, or we have invested in the debt mutual fund. So we will exposed to the interest rate risk. So generally everybody who either wants to borrow or either wants to lend money will have the interest rate risk. And there are various methods are available to mitigate this interest rate risk. So in case of equity, you have equity futures, equity options, and in that index future and index options. Okay, but in case of interest rate, you have a forward rate agreement where the underlying is interest rate, pure interest rate, say overnight index rate, or 10-year GSEC yield, or SBI MCLR rate. So this is the on which you will do the forward rate agreement, that at this rate I will borrow after 6 months. There can be a bond forward. So here I am saying after 6 months I will buy the bond. So underlying can be pure interest rate, can be interest rate instrument like a bond. There can be a instrument like a notional bond. So bond does not exist. The synthetic bond is created, and against that you can have a future or a forward. So that is called a notional bond. Then you have a futures on the bond index. So you can see that on the variety of instruments it is available. Swap market, interest rate swap is the most traded and the most flexible market available across the globe, and I think it is the highest having no the highest traded derivatives and highest traded notional value, outstanding value is against the interest rate swap. So that is a so much liquid market is available. Then we have a option. So generally we have a normal European options in case of equity. Here you can have a interest rate options. You can have a swaptions, which is a derivative on derivative. You can have interest rate caps. You can have interest rate floors. So various varieties of instruments are available because we have seen the varieties are underlyings are there. Varieties of risk is there for the market participant. So person holding a G6 and of a 5 year, and a person holding a G6 of a 10 year, or a person holding a corporate bond of a 15 year, they may have a different interest rate risk. So they may try to basically use a various interest rate derivatives products to avoid this interest rate risk. And for that, it is very important to learn about the interest rate derivative. So it is not that easy of learning only futures and options and the interest rate derivatives, because In case of interest rate derivatives, the pricing is different. It is totally different as compared to your equity because there is a coupon is also there. So there are a lot of different things as against the normal futures and options which are available for equity. And these things are basically available in your e-learning model, which is related to interest rate derivatives. So in interest rate derivatives e-learning module, you are going to learn all things related to interest rate derivatives. So that's why you can see that all these four models are very, very important and they are actually correlated. So it is very important for you to first learn the securities market, sorry, securities, what is fixed income securities. Then you have to learn the bond mathematics. Then you have to learn the fixed income market or interest rate derivatives and or vice versa. Means you can learn first fixed income market and then interest rate derivatives. But it is you have to go from fixed income, understanding the fixed income securities to the interest rate derivatives. So these are the four things are there. Now I briefly touch upon why fixed income securities are very, very important and why you should learn about the fixed income securities. First thing, there is a huge scope for the fixed income market in India and across the globe because everybody wants to borrow money through a debt market. It is long term cheaper to equity. It is easy to raise money through debt because when you do through private placement, it happens faster. You know what is your outgoing in advance because you know how much coupon you have to pay, how much principal you have to pay. So there are a lot of benefits which are available when somebody borrow from the fixed income market. So it is as important as the equity market. And you have a huge scope in a fixed income market. When I used to go in bank, we used to say, okay, agar bank mein if you go in treasury department, you will find only three dealer who is handling equity portfolio, and you will find a 20 dealer who is handling the fixed income portfolio. Why? Because somebody is looking after money market instrument, somebody is looking after asset liability mismanagement portion, somebody will look after the SLR portion, so because banks has to ensure SLR. Banks act as a primary dealer, so somebody has to ensure the primary dealing activity. Somebody is purely doing trading on the government securities and doing a speculation, and few people will be only handling the non-SLR desk, which is a non-government securities desk. So you will see that there in fixed income there will be 7 8 segment will be there, and somebody who is basically doing the interest rate swaps and interest rate derivatives. So many people will be there in the market. So you have a RBI who are the regulator, but RBI is regulator. They manage the G6 for Government of India. They do the issuance on behalf of them and state developments. They do the open market operation in G6. RBI provide a anonymous order matching platform for the trading in G6 through CCI. So they play multiple role. Then SEBI is there. Banks again do a lot of bank acts as an issuer. They act as an investor. They do a trading. Similarly, insurance company, primary dealers are the underwriters in the government securities. They are again a very big player in the equity, in fixed income market, including G6, state development loans, and non-government securities. Then another important players are mutual funds, who they are having a huge debt funds or a credit fund, so or a hybrid fund. So there will be a debt portion. Then there is a liquid funds which invest in the money market. So all for that mutual funds is a very big investor in a money market. Now, one important thing as far as market participants, there are few market participants like banks, insurance company, primary dealers, EPFO, provident funds. They have a mandate. So their regulation says that certain percentage of their total AUM they have to invest in the G6 or a state development loan or a government, a non-government securities. So you will find that everybody is investing in the debt market. It is possible that some bank may not investing in equity at all, but everybody will be investing in the fixed income market. So these are the various players, and these are the another few players who are, when I am talking about financial institutions like RAC, PFC, NABARD, SIDBI, NBFCs may lot of home finance company and other NBFCs like say Muthoot Finance or Bajaj Finance. So those companies are basically mainly issuers, and they are the investors. So if you see in India, 80% of the corporate bond issuance is done by the financial institutions, okay, including banks and other financial institutions, and only remaining 20% is by the other people. So this is the way it is important for the financial institutions, NBFCs and banks. So these are the various market participants. So you have a scope. If you have a very good fixed income knowledge, you have a scope in all these places. Like then you have other people like exchanges, CCs, valuation agencies. Now entities like FBL, entities like FIMMDA, they are closely associated with the fixed income securities. Then credit rating agencies do does the rating of the bonds. So these are the various players who are either directly or indirectly linked to the fixed income securities. And these are the just I have given a few slides. Okay, now if you see today, what is today's GDP of India? Our GDP is around 4.3 trillion US dollar. And in 2046, 47, we are thinking that you should have a USD 30 trillion GDP. So you can see how much the gross borrowing or the borrowing will happen by the government, central government, which is the government of India, and from the state development loan. So this market is going to grow only. Okay, it is not that okay the gross borrowing is going to come down. Now take the example of corporate bond issuance. Now in India currently 112 lakhs crore is outstanding of G6, around 64 lakhs outstanding for the state development loans, and around 54 lakhs is outstanding, 54 lakh crore is outstanding for corporate bond. If you see for 2024-25, we have the record number of private placement amount raised by the companies, which is 11 lakh 50,000 crore. So you can see that the corporate bond issuance is increasing on a continuous basis. If you see the data, you can easily see that, and the outstanding issuance is also increasing. And even though it is increasing, we are far behind the other countries. Like in US, the corporate bond to GDP ratio is 37%. And in India, the ratio is only 16%. In South Korea, it is around 75%. So you can see how tremendous growth opportunities are available for us in a fixed income space. So showing this information, the idea is that there is a huge scope is available in fixed income securities. And that is why it is very important for you people to learn about the fixed income securities in depth. And for that, I think this e-learning all four model give you the very important and a very good base for learning about the fixed income market. So same way about commercial paper and certificate of deposits. People does not know that. People think, okay, the debt market is a very liquid market. You can see the statistics. On a G6, we have a 66,500 daily crore of volume is happening on a daily basis. Equity, we have a volume of 1 lakh crore. So it is almost 67% is happening in the equity in a G6 market. In corporate bond market is less liquid, 5,000. Again, there is a huge scope that increase from this 5,000 to 25,000 crore. So this market can easily grow from 5,000 crore to 25,000 crore market. Money market, the volume is staggering. You can see that repo market, the volume is up to 5 lakh crore, and I am talking about a daily volume. None of the segment have a volume of average daily volume of 5 lakh crore. So you can see that huge trading is happening in the fixed income place. Interest rate derivatives, again, huge scope in India. In India, interest rate derivative is the last market. We have a equity, commodity, currency developed, but interest rate market is not developed. Internationally, the number one market is the interest rate derivatives market. So in OTC, you can see that the number one is the interest rate derivatives market. So again, there is a huge scope is available in derivatives space also, especially OTC as well as in exchange traded place. So the idea is showing you all these data is that there is a huge scope is there in the fixed income market. And if you want to reach to this 30 trillion, the fixed income has to play a very, very big role in the financial market. And I think this e-learning program is very important because it has covered everything. It covers fixed income securities, fixed income mathematics, which is very important, and then it covers how the market works, And if you want to hedge the risk of this fixed income, how you can hedge this interest rate derivatives risk, or how you can speculate, or how you can arbitrage using interest rate derivatives. So the course covers everything about this, and that's why it is very important to, again, I will say ki go in sequence. First go fixed income securities, then maths, and so on. So that's say as FIMMDA sir has already said, only sir, that this course is applicable to everybody. So it is useful to everybody, even a newcomer or somebody who is studying in MBA finance, where the fixed income is also equally important to equity, on anybody who wants to go in a financial market, whether it is a bank or a mutual fund or a NBFC, or even in a regulator like RBI, SEBI, everywhere fixed income part will be there, and that's why it is very, very important. So that's it from my side. Thank you. So we can open for a question.
Thank you, Sunil, for that very informative presentation on fixed income, and also for highlighting that our fixed income courses can be taken by a slew of people. It can be students, it can be professionals aspiring to make a career in fixed income. It can be people who are already in the securities market but want to learn more about fixed income. And fixed income is generally very less understood, right? And less popular, may I say, compared to equities. People are much more focused on equities, how to buy directly, etc. But the awareness or the knowledge regarding fixed income is definitely on the lower side and needs to go up. And the fixed income market is huge, as Mr. Sunil rightly showed. The government securities, corporate bond, the markets are huge. The trading is also substantial, and it is good to know about this market and how to get fixed income securities in your portfolio if you are an investor, etc. So we'll just quickly go to the Q&A. We are nearing the end of the session. We have couple of Q&A. So Sunil, one of the couple of the queries centers around how RBI's monetary policy transmission affects yields on government securities. So you want to add a bit on that?
So basically, whenever generally we you see whenever RBI come with the rate cut. So in India, what happens? There is a generally yield curve. There is a shift in the yield curve. So suppose RBI reduce the rate by 25 basis point. So especially at a lower side like a call money market, the rate will change immediately by 25 basis point. But you may not see the same shift at the higher end. So suppose the 10-year yield is say 6.58%, so it will not reduce by 25 basis point. It may reduce by 5 basis point or a 10 basis point, depends upon the various factors, because what RBI is talking in the monetary policy, whether they are dovish or they are neutral. So those things also have an impact especially at the long side. Also, how much government is going to do the borrowing in the next fiscal or the next calendar year or next 6 months. So those things also have a impact. So it is not that okay, RBI has reduced rate by 25 basis point. It means that the G6 will be dropped 25 basis points across the maturity tenor.
Absolutely, absolutely. Yes. That's very true. That is something for the participants to keep in mind, that usually, yes, when there's a rate cutting cycle and RBI is in an accommodative stance, we expect that GSEC yields would go down. But we also should keep in mind that the market is also very savvy, especially the institutional market, and market discounts many things in advance, just like it also happens in equity markets, etc. So sometimes participants may discount interest rates well in advance. So if there has been a 25 bips cut, but participants expect 50 bips cut more, so they may discount it already and it may reflect in yields. And like Sunil said, that there are a host of other factors which impact. So recently we saw, and this was a question from someone elsewhere, that RBI cut rates couple of months back, but then after that we saw long-term yields rise. So one of the things could be that the cut was already factored in. Plus, when the GST 2.0 reforms were announced, Sunil, I think there was some concern in the fixed income market that borrowings can go up because government's revenues can come down, right?
Correct, correct.
Yes. So those kind of things there is a query from Vedant who wanted a repetition on If you can just briefly explain call and put option, Sunil, in a fixed income
Okay,
security.
what happens is suppose there is a 5-year bond, so which is issued today on say on 1st April 2025. So the maturity will be on 1st April 2030. But suppose the issuer has said that there is a call option after 3 years. So that basically give right to the issuer to redeem bond on 1st April 2028. So what is written in the scheme, it is important that after 3 years, any point of time, or after on a 3 year or and on the 4th year. So then it gives right to redeem the bond before the maturity date. So he can call the bond before the maturity date. In case of put option, it gives the right to the investor to redeem the bond before the maturity date. Suppose now the same bond has a put option also after 3 years. So after 3 years, the investor can go to the issuer and he can redeem the bond after 3 years, even though his original maturity is for 5 years. So that is called a call and put option.
Thank you, Sunil. So that was good to clarify. And there was one more question. I think this is a very basic and fundamental question. That can you explain the difference between YTM and current yield?
So basically, current yield means there is a formula. Okay, current yield means your coupon rate divided by price, and you will get the yield. And YTM is yield to maturity, where you discount all your cash flows with a specific rate, so that the present value of all your cash flow is equal to your price. And in normal term, it is called the internal rate of return. So in the market, yield to maturity is used by the market players when they want to trade. So if somebody wants to trade, they generally show the yield to maturity. Current yield is not basically used by the market participant while trading. So there is a different formula. And YTM, see, anything, any number is not a sacrosanct, but YTM yield has, I will say, more theoretically better as compared to your current yield.
Absolutely, Sunil. Yashika, I hope that answers your question. YTM is really, while not perfect, it is the most relevant measure of, yield that is used by market participants, institutional market participants. Current yield may not be so accurate, so you should really focus on the YTM. And to calculate YTM, you need to know the bond cash flows and understand bond mathematics as well. And this is where our courses can really help you to do that, right? So thank you, Sunil, for answering that. And yeah, so we have really run out of time. I would request all webinar participants, please go to NISM e-learning, online.nism.ac.in, where you can get more information about the 4 e-learning courses that we run in collaboration with FIMMDA, which are specifically targeted on fixed income, and can be very useful for those of you who want to learn more about fixed income online. These are online courses, self-paced. You can learn at your convenience, sitting anywhere. So please do check out these courses. You will get many more details on the LMS, definitely. With that, I would like to conclude today's webinar. I would like to thank Mr. Murli Shiraz from FIMMDA team and Sunil, who gave a very detailed and simple and informative presentation on fixed income. And thank you to our participants. I hope all of you found it informative. And like I said, please do check out the LMS for enrolling in the courses. Thank you.
Thank you all.